if you're working in Australia, paying into super or planning for retirement, there are some important changes that started from 1 July 2026. Some of these changes could help you invest more, save more tax, and even increase your retirement savings. Others could affect high-income earners, business owners, and people approaching retirement. In this video, I'll explain all 10 major superannuation updates for FY27 using simple examples, so anyone can understand them. Let's begin. The first update is simple. The super guarantee rate remains at 12%. This means employers must contribute 12% of your ordinary earnings into your super fund. If Emma earns $100,000 a year, her employer contributes $12,000 into her super. This money is separate from her salary. This is probably the biggest super reform in years. Previously, many employers paid super only once every quarter. That meant your money could sit outside your super fund for months. Under Payday Super, employers will pay super at the same time as your wages. Imagine Jack is paid every 2 weeks. Instead of waiting months, his super is invested immediately. That gives his money more time to grow through compound returns. Even a few extra months invested every year can make a significant difference over decades. This rule mainly affects very high income earners. For FY27, the maximum contribution base is now $270,830. Employers generally don't have to pay super guarantee on income above this amount. If someone earns $350,000, their employer generally calculates compulsory super only on the first $270,830. This is great news for people making extra super contributions. The concessional contribution cap has increased to $32,500 per year. These contributions include employer super salary sacrifice, personal tax deductible contributions. Sarah contributes a total of $30,000. Since that's below the new cap, she stays within the limit. She could even contribute another $2,500 before reaching the cap. Didn't use your concessional cap in previous years? You may be able to catch up. If your total super balance was below $500,000 on 30 June 2026, you can use unused concessional contribution caps from the previous 5 financial years. Suppose Michael didn't fully use his caps over the last few years. He has $15,000 of unused contributions available in FY27. He may be able to contribute that extra amount and potentially claim a tax deduction. Here's a bonus tip. Because of Australia's tax offsets and tax rates, the effective tax-free threshold for FY27 is approximately $22,866. That means many Australians earning below this amount may pay little or no income tax. Remember, this is different from super rules, but it's useful when planning contributions and retirement income. The annual non-concessional contribution cap has increased to $130,000. These are contributions made using money you've already paid tax on. No tax deduction is claimed. If Lisa receives an inheritance or sells an investment, she could contribute up to $130,000 into super without using the bring forward rule. Eligible Australians can contribute up to $390,000 in one financial year. This is called the bring forward rule. Generally, to access the full amount, your total super balance must be below the relevant threshold, around $1.84 million from 1 July 2026. Imagine David sells an investment property instead of contributing only $130,000, he contributes $390,000 using the bring forward rule. That allows him to move more money into the tax-effective super environment sooner. The general transfer balance cap has increased from $2 million to $2.1 million. This is the maximum amount that can generally be transferred into the tax-free retirement pension phase for retirees. This increase allows more money to move into the retirement phase where investment earnings are generally tax-free. Keep in mind that individual personal caps may vary depending on your circumstances and prior use of the cap. The government co-contribution scheme continues. Income thresholds have increased for FY27, while the maximum government contribution remains $500. Suppose Chloe works part-time and earns a lower income. She contributes $1,000 to her super. If she meets the eligibility rules, the government may contribute up to $500 for free. That's an instant boost to her retirement savings. Finally, a reminder about Division 296. This proposed measure applies additional tax to certain earnings associated with very large super balances, generally above $3 million. There has also been discussion around higher balance examples such as $10 million when illustrating its impact. This measure has been the subject of ongoing debate and implementation details may evolve, so it's important to stay updated and seek professional advice if you have a very large super balance. For most Australians, this change won't affect them. But for individuals with multi-million dollar super balances, it's something worth monitoring closely. Those are the biggest superannuation changes for the 2026-27 financial year. Some updates affect almost every Australian worker, while others are particularly important for higher income earners and people nearing retirement. Understanding these rules can help you make smarter contribution decisions, reduce tax where appropriate, and build a stronger retirement fund over time. If you found this video helpful, please like, subscribe, and share it with friends or family who want to stay up to date with Australia's latest superannuation changes. Thanks for watching, and I'll see you in the next video.